Sorry. Welcome to Wise Tech for Wise Money. Today we're exploring algorithms and interest rates, how AI is reshaping fixed income markets. We hope by the end of the podcast, the audience will have a greater understanding on how the fixed income markets work and the influence AI may have on it now or in the future. I'm Gary Wayne from A1 Solutions, and I'm thrilled to have Andy Brenner joining us. Andy is head of international fixed income and part owner at National Alliance Securities, a boutique firm that's been navigating bond markets for decades. Andy, you've witnessed market cycles multiple times, and now you're seeing algorithms and A1 fundamentally reshaping how we approach interest rates, trading and risk management. Welcome to the podcast.
Gary, always a pleasure. Glad to be here.
Yeah, good to see you again. Andy, could you tell us a bit about your background and how you're seeing technology transform or impact the fixed income market, if at all, and markets in general, especially at National Alliance?
Well, my background is I pretty much did a decade at Nomura and trading fixed income. And then I was a division of Société Générale. Then I moved on to Investec, and I ran fixed income for them for about 5 years. And then I moved on to MF Global. That was when they were in their heyday before they went out of business. I left there early on and went to Guggenheim. Was at Guggenheim a bit. Great place to work. And I've been at Nat Alliance now for about 14 years. And, it's a firm where I bought into and I own it with two other guys. And it's been a great experience. We've got about 70 people working for us, the whole spectrum of fixed income. And it's been a good year. So I'll leave it at that.
Fantastic. Let's start where we are today. Fixed income has always been about relationships, intuition, etc. But now algorithms are making split-second decisions on interest rate and market movements. How's this transformed or played out at National Alliance?
Well, as far as let's just talk about the general markets first. You see a lot of moves based on algorithms. A little bit quiet this week, but this time of year. But I expect, maybe after Powell speaks tomorrow, the markets could move some, and I really do expect a big move off the next employment number on September 5th, because employment is one of the key things that people are looking at. Algorithms can move markets 5, 6, 7 basis points in a drop of a hat, which is something that markets never used to be able to move in that quite speed. But what's happened now is over the years, the dealers have cut back the amount of capital that they've allocated to trading. So with the dealers, the primary dealers and the other dealers really not putting as much money into the markets as they have in the past, markets can get a lot more whipsawed. And you see it with commodity trading advisors, you see it with hedge funds, fast money. They're very, very active in the futures markets, which then pushes the cash markets. So, based on a headline, based on a lot of things, you can see these quick moves. So you have to be, basically what you have to do is let them move out and then fade them, because generally it tends to come back. But, there is a lot of trend trading. As far as what we see at Nat Alliance, we're more of a boutique. We're not really involved in the fast moving that the algorithms are doing. We're more derivatives trades. We're more in IOs and all kinds of esoteric and munis, which do not move like that, and corporates, and all kinds of other esoteric type mortgages. So, the algorithms don't really affect my firm, nor do they affect my day-to-day.
Have you seen any surprises with the way the algorithms penetrate interest rate markets and the markets in general? I mean, from my experience, I think algorithms obviously affect the futures market, which must affect the derivatives market, and obviously the equity market all at the same time. Are your clients now asking different questions now that AI is influencing some of these market moves?
Well, I don't know how much, unless you want to call algorithms AI, which you might be able to make a case that they are very similar. Yeah, people ask me all the time. That's why I put out a morning commentary as to what I see affecting markets. You're going to see the options markets. You're going to see the commodity trading advisors. Second time I've mentioned them. You're going to see a lot of positioning and so on and so forth. People want to know where the positions are. People want to know how they're situated. So, you can see the next move. Look, I will tell you, this year, the commodity trading advisors and the hedge funds have not had a very good year. Of course, there are always hedge funds that do well. Some of the crypto hedge funds, I saw one guy said he was up 600%, but generally speaking, most are down or underperforming this year. Certainly underperforming the European equity markets, at least for this year.
How are compliance requirements evolving with these new tech situations in the market? Is compliance being affected? Are you having to drill down on the processes more when onboarding clients, etc.?
I'm not aware of any additional requirements, at least from our point of view, as far as the fast trading. Obviously, Bitcoin has its own set of things, but we're not involved in the Bitcoin market. I mean, we watch it and we see how it affects some of the equity markets and some of the derivative markets. But no, we have no changes. We are using the same kind of compliance standards that we've used in the past.
So in essence, AI is not really making a lot of difference to your strategies or your daily operations. Well,
No, I will say, well, first of all, in our trading operations, AI is not having a major effect at all. In our banking operations, it's helped us to draw up contracts and get through large documents and get summaries and so on and so forth. And we have a lot less to do with our lawyers because AI will help us write documents per se, and then we just have them reviewed by a lawyer as opposed to the lawyer writing the whole thing up. So it has saved us a lot of time and a lot of money so far in our banking boutique. But as far as our day-to-day trading, no, I haven't seen where it's affected us.
right, okay. So when it comes to rate analysis, you still need obviously a lot of human judgment. I mean, you can't rely on tech to analyse what we think the market might be doing next week or what it might be doing in an hour. I mean, really,
Well,
I read your comment, that comes from your experience. I can't see how AI can take the place of that, unless you're seeing stuff that I'm not.
Well, it's funny you're mentioning that. You're absolutely right. I mean, I look at traditional stuff. I look at, we get coverage from some of the bigger dealers, give us their ideas. We use the Bloomberg, and it's always got stories and so on and so forth. And we know where to look to get the information, and then we do an analysis based on that. But I am working with some friends of mine at the University of New England who are AI specialists, and we're talking about actually maybe doing a podcast or a YouTube and using AI in that. But at this point, it's just in the preliminary stages. I really only talked to him about it yesterday.
Well, can you just sort of elaborate on that? How would you use it?
Well, I've been dealing with a couple of professors who are AI specialists, and I think AI is really in its beginning stages. I don't think anyone really knows exactly how to use it or how to best use it. Obviously, it's going to save time, it's going to change jobs, and so on and so forth. It isn't going to change my job for analyzing markets, but it could summarize a lot of information I get very quickly once it understands what I'm looking for. And I like to look at changes. I like to look at differences. I like to look at different opinions. And if AI can save me half my morning, in figuring out what the markets are going to do, that's very helpful. But so far, we haven't figured out exactly how to do it. But I believe, look, when this past week, a couple of times, Bloomberg, when they write a story, the first three paragraphs or the first three big headlines are AI AI created, basically summarizing the Bloomberg story. So if I'm really pressed for time, I'll read the top headlines as opposed to the full story. And I'll get an idea of whether I want to continue reading that story for more information. So in that sense, Bloomberg's using AI and I'm using Bloomberg's AI. But, as far as trading strategies, trying to determine where things are, look, I look at the 200-day moving average of 10 years. I look at where 10 years have been. I look at what I call the magnet number for 10 years, in other words, where it's been going back and forth from. And right now that number is 430. It was 425 recently. It would go up and down and so on and so forth. That's not really AI. That's just, good old traditional analysis. And of course, I know the history of where the 10 years have been. 450 is a key level, 4 5/8, 4 3/4. 5% really isn't a topic for this year, but 4% could be. So, that's, again, not AI, but I think I could use AI to save some time with it.
Have you seen any situations where algorithms have sort of read the market wrong and caused a really bad sell-off, or a buying situation where in fact it's got the info totally wrong or misread the information?
Well, we see that all the time. I mean, when there are headlines that come out of the blue, the first headline could be the unemployment number, soared. Like even if you looked at last month's unemployment number, the initial reaction was that it was the headline number was only slightly off, and the market started going in the wrong direction, which is going, which is basically going down. But then when the second numbers came out, all the revisions, the 258,000 revisions, the market reversed. So in short instances, you can see a headline, the algorithms work off the headline, and sometimes they get it wrong because the headline, the underlying doesn't back up what the headline is saying. And then once all that stuff gets out, it normalizes. So yeah, I see it all the time. We'll move in the wrong direction, for maybe 4 or 5 minutes, and then it'll reverse itself.
From a compliance point of view, do you audit these sort of moves?
Well, compliance really isn't involved in trading per se. I mean, people can trade any way they want for whatever reasons they want, whether it's direction, whether it's credit, whether it's, basically value. So no, compliance really isn't involved in the day-to-day trading as long as we're following the rules that are set up in compliance. I mean, there's no insider trading. I mean, look, if I see a headline in Bloomberg and I'm smart enough to look at the revision and I want to fade which way the market's going, that's just trading. That's just good old time analysis. So yeah, I see a lot of times when the algorithms get it wrong and then they have to reverse.
Whether we like it or not, the market still sees some front running. I know it's illegal and shouldn't happen, but do you see AI or algorithmic trading preventing this, making it more of a level playing field, and actually preventing these actions?
Not at all. I don't see AI giving any benefit. I could be wrong, but look, there's no question that at 828 for an 830 number, you could start seeing some stuff that just doesn't look right. Maybe the Department of Labor has put it out on their website without, putting it through their normal process. We've seen that a few times, or a number could leak out and some people see it. And then, of course, you have the guys who like to have their computers close to, where the information's coming from because they might get a quarter of a second edge or something like that. But yeah, I've seen funny things happen that I can't explain, and I point them out from time to time. But I'm not trading in that kind of detail. Again, we're a boutique, but I do observe what you're talking about. Yeah, there are a lot of times when it looks like a number's been leaked or some information's been leaked, and occasionally you can find out what that is. But no, I don't see where AI is going to change that because AI is going to be, look, the AI doesn't know what the market is. But let me give you a better example because this is where I think this might actually be better for you in this respect. Look, I've known I know you've only been reading my stuff for the past month, but over the last couple of years, we've noticed some strange things happening in the employment situations. in the employment numbers, and they're constantly getting revised, and they're constantly getting revised lower. And it just tells me how bad the Department of Labor is. Now, while I don't endorse what Trump did, firing the person in charge of the numbers, especially blaming him for a political reason, but I do endorse firing because they kept getting it wrong. They haven't used AI. They haven't used technology. They're still using landline phone calls to determine, to take surveys, and then they can't get people. So they get 30% based on the number. Then when they call a month later or over the next month, they get a 60% certainty. And then finally, after 3 months, they get a 90% certainty, which tells you that the numbers that you just got 3 months ago were wrong. And the numbers you got 2 months ago were wrong. And I mean, it's just horrible. They're not using AI. I use the joke that they're still using an abacus of which to determine, how they calculate things. I think they would have been better off using a dartboard because their numbers have been so bad. So in that respect, I think AI will help, but I don't see the Department of Labor, even with this new guy being proposed, I don't see where they're up to speed. They need to get better on this. That's giving us bad numbers, and that's not front running. That's just bad numbers. I mean, look, if the Fed, if the unemployment numbers had been correct in May and June, the Fed would have eased in July. Absolutely. In fact, the Fed might have even eased in June and again in July. We'd be 50 basis points lower going into September. But no, the Labor Department is using 30-year-old technology, not even AI, which is forward-looking. And all that is available to them. And so in that respect, yeah, I mean, AI could do a lot for it. As far as the actual trading of the AI numbers, now, look, the algorithms have been getting stuff pretty quickly, but I don't know that AI is going to be smarter because you've got people like myself with 30 years experience, and we know how bond market's going to react. And while we don't get it right all the time either, I don't see where AI is going to be that much better, in that. But I think getting the information to us, getting more accurate information, that I think is how AI can help.
Yeah, I agree. I mean, when we look at all these huge revisions, and they've been going on all my lifetime, as they have yours. In the marketplace, I remember when I was doing FX, when I was involved in futures, all these revisions caused huge volatility and still do. I mean, when it comes back down to that, risk management in fixed income is obviously trying to predict rate movements and protecting against this volatility. AI promises obviously to help us see these risks faster, but it also probably creates some blind spots. How do we deal with that?
Look, you just have to have people with experience. You have to combine. At this point, you're not going to run it all on AI. You have to have a degree of experience. And look, I mean, I'm sure Goldman Sachs, when they look at their positions, they probably have some kind of AI model looking at their risk parameters, and so on and so forth. And then they have experienced people, whether they have their CFO, whether they have their head of trading, and so on and so forth. They all have opinions as to which way they're going. And the big shops still do trade, and they take large positions based on price and based on a trend. But AI will help in the risk analysis, but it's only one aspect. I haven't seen where it's gotten good enough yet to be more than that.
Are we seeing new risks emerging with the algorithmic trading?
Gary, I don't think algorithmic trading is all that new. I mean, I think it's been going on for a good 5 years. So yeah, do we see risk from algorithmic trading? Yes. Do we see hedge funds outperforming because of algorithmic trading? I'm not convinced of that. But every once in a while, algorithmic trading will get it right. They'll be in front, and the trend will continue in the direction that they're going. But I haven't seen that as happening so much this year. This year's been a back and forth market. You
Yeah.
trend on occasion. You'll move 20 basis points, and then you'll be in a range again. So if you get that 20 basis points right, whichever direction it is, that it's fine. I'm not sure algorithmic trading's been that good in that. But no, I haven't seen big, large moves. I mean, look, you could have trends of 100 basis points. I don't see that happening anytime soon.
I've seen during these podcasts, etc., and this recent exercise, I've talked to a lot of people. And obviously, I talked to quite a few people also on the retail side as well as institutional. And, there's a lot of the new trading apps and bots out there influencing how retail buy and sell shares, how they buy and sell futures, etc., giving them a lot more confidence. Do you think this is causing any underlying current within the market that actually affects the market we see? I mean, it's just a question I'm interested in.
Look, Gary, I must get 20 things a day from people telling me how to trade, what to trade, whatever. Pretty much I put them all in the trash. I mean, there are some that I follow. Look, I love the guys at In Touch Capital rather. But they're informational. They're not going to tell me which way to trade, but they're going to get me the information, the headlines quicker than Bloomberg is. But Bloomberg gets them out pretty quickly. Do people have these ways of trading? Yeah, Gary, look, if any one of them was so successful, then we would hear about them independently. And you know what? There are some that are very successful, but they're doing stuff in some of the markets that have been moving. Look, if you could get involved in crypto and knowing that the president was going to move towards lightening up the regulations on crypto, you made a killing. But, crypto is not something I trade. Above and beyond that, yeah, look, did we see that? Did we see the Trump tariff debacle or the Liberation Day? Did we see that as an obvious play to short the dollar? Absolutely. But now it's not. I wouldn't say that's AI generated. That's just common sense. One of the things the Trump administration was trying to do in order to help their balance of payments was to get the dollar lower. And they've accomplished that. Now the question is, do they still want to do that? They're acting like they do, but it seems like the dollar's not cooperating. It seems to be steady. Look, I mean, Morgan Stanley thought the euro was going to go to 127, and it still may. But right now, it's been in a 116, 117 type range for a good amount of time, and I don't see a lot of that changing. So yeah, there are trends, there are things that you can, get on board. But as far as the traditional stuff that I trade, which is, bonds, treasuries, corporates, municipals, um, a lot of them have been range bound. Again, they'll move 15 or 20 basis points and then they'll stay. And, right now I still find corporate credit as being a very good asset to be in. You can get 5.5%, 6%. Keeping yourself in the short end of corporates, and I think that's pretty good. If you look at the year to dates on the Bloomberg Ag indexes, the global ag is outperforming. That's because the dollar's lower, and European companies have done well. But generally speaking, it's going to be the high yield or the corporates that outperform. And right now, high yield and corporates are doing okay, and they're outperforming treasuries, but not by a significant amount.
Do you see regulators keeping pace with all these technology changes? I mean, we know that the department that handles all the economic numbers are behind and not using technology. Are the regulators on top of this?
Well, I don't follow the regulators that closely, Gary, but my estimate is no, they're not. That regulators are usually made up more of lawyers and not of traders, and I think that's been something that's been a problem for the regulators over the years. They don't keep up with things. I see pressure on the Fed and the banking regulators to keep on top of stuff. I see deregulation happening from Trump, which I think is good. I think the supplemental leverage ratios are being reduced, but it seems like while they are being reduced, banks don't seem to be using their full amount anyway. So I'm not sure how much of an effect that's going to have, but at some point I think that's a good thing. You see, changes happening with Fannie and Freddie. I'm not really sure what the government's trying to achieve. I would love to see them go private, but then again, someone has to guarantee that mortgage. All the mortgages. In other words, the mortgage spreads are going to go higher, and that's going to hurt their ability to get the housing market, which is one of the weakest markets in the United States right now. I don't know how it is in Europe, but it looks like from what I read, in the UK, housing is slowing down there as well.
Great. With your experience, and obviously you've been around a good many years, how do you see interest rate markets changing, and how do you see technology affecting the way we execute and do this business in the next 5 years? Obviously, we probably can't even go up to 5 years because things change so quickly, but let's say in the next 1 to 5 years.
Well, Gary, what I've seen, if I were to look at the corporate market is very transparent. So what has happened is that companies don't put as much money into their balance sheets to trade corporates in the secondary market. So you see a lot of stuff going through electronically. You'll see something like a Market Access or TradeWeb get all these big bid lists. You'll also see companies that will actually give a list of bonds. You have to bid for all 10 bonds, and it's a one number thing. And that requires a lot of capital for some of the bigger firms. Or what happens is you'll see it now bypass the dealers and go directly to the end users. Anyone can bid for it on one of these systems. So you see a lot of things changing electronically. As far as treasuries, they're pretty much electronic anyway, so I don't see a lot changing there. I think there's a lot of transparency. I think it's probably going to affect derivatives. I think derivatives are going to come more transparent. I think options are going to come more transparent. But I'm not so sure how it helps. A lot of people look, Gary. Look, if something is very transparent, you have to be more right than wrong. If something is less transparent, then there's a bigger spread in it, and it makes more sense for you to get involved. That's why I think we have private credit and private equity have really expanded dramatically, because there's less there's less regulation on them, and there's less transparency.
Okay, cool. And smaller firms, how do you think how can they compete in this technological world and this AI-driven market?
Yeah, I think that's a problem, because the smaller firms have been based on on relationships, and as the guys get old and the guys retire, the new relationships aren't going to be as strong, and as the electronic aspect of trading continues to make inroads, I think you're going to find that it's going to hurt the smaller firms. And that's why the smaller firms have to deviate from stuff that is very transparent to things that are less transparent, which is why we started a banking boutique, 5 years ago. And, that's working out well for us. So you have to look at the areas where there are spreads and where there's ability to make money. Banking is one of them. If you're, putting together deals for companies, that's not as transparent. If you're trying to trade, 50 million 5-year IBMs or 20 million Fords, it's too transparent. It's very difficult. Everyone's going to know you have that trade on, and what have you. Or you'll get a customer to back you up, and you'll make an eighth of a point or a quarter of a point, and so on and so forth. Not really worth it as far as I'm concerned.
So yeah, you talk about transparency, and I'm only I'm not trading like your guys are, but I remember when the futures market went from open outcry to obviously electronic. And we went from being in the pits to seeing orders flying around and quite transparent if you were any good, to an electronic system where you just didn't know what was going on, where anything was coming from, and you got buried. So in the electronic algorithmic world or AI world, how do we monitor and get that visibility?
Well, Gary, I think you have that visibility just by looking at the screens. I mean, you have instant updates on everything that's trading, whether it be the currencies, what have you. What you don't have is you don't have the information that someone has. In other words, if all of a sudden someone wants to come in and sell $1 billion of something, you're not going to know about it. It's going to push the markets against, the area that in whatever direction they're going. But no, what I'm thinking about is you're thinking about, because you grew up as a futures trader, so you have more transparency. I grew up as a credit trader, so I had much less transparency. And what's happened in the markets I used to trade, and I still do trade them, but much less frequently, that transparency has gotten to the point where everyone knows what you're doing, everyone knows the last price, and everything is published within 15 minutes of when you trade it. So you know what? I've moved away from that market because I find it very difficult to make money in those kind of transparent markets. Now, what you're talking about is markets that are already transparent, that people have an edge on information or news or what have you. And that's something regulators can get more involved in. But you know what? News, look, if it's published, on Bloomberg, which is the first, because everyone has a Bloomberg that's trading, or it's published at Reuters, or whether it's published in the Financial Times or what have you, depends when you see it as to know what's going on, which is why I have some services that I have that keep me up to date on what's going on. They have groups of 10, 12, 15 people that do nothing but, analyze where information is going, and then you use the information of which to trade in the direction, or you hedge yourself because you know what's going to happen. What I'm very good at is looking at what the news is going forward. Like, I care less about the inflation numbers. I know they're going to go against me slightly. I care more about the employment numbers because that's something I think the Fed is missing. That's something I think the government has screwed up. And I think that's something that's going to, is going to wake Powell up to the fact that, my goodness, the, employment situation in the U.S. is going crazy. Look, I told you about the bad numbers. I mean, last year we had 818,000 revisions in employment. Gary, that's almost 1 million people.
Yeah,
I mean, come on. I mean, you get that dartboard out. You would have done better. All right. And now we just saw, the last 3 months, where they revised 2 months down 258,000. These are numbers that were, huge numbers that are now, I think the numbers were 120,000 and now they're 19,000 for the month of May, similar for the month of June. I mean, that's crazy. And Gary, and we haven't even talked about immigration. No one knows what's going on in immigration in this country. Trump sealed the borders, which is what he said he was going to do. But now you have all these immigrants who are working underground. It's screwing up the unemployment numbers. You're taking away numerators. You're screwing up denominators. Jay Powell thinks that employment is at full employment at 4.2%. Well, you know what? If you're not counting a lot of people, or you're counting people wrong, the unemployment number could be 5.2%, in which case then Powell has a real problem. And that number is going to happen overnight. And that's why I think the Labor Department needs AI, needs up-to-date computers, and should probably off-source what they do to a technology company like an IBM or, or Price Waterhouse, who's ever doing that kind of stuff right now, because they're horrible. And that's something the regulators should look into. But that's the government already. And basically an AI model, if you have a good AI model, you're going to be able to determine, hey, these Labor Department numbers don't look right. But you know what? Every month it's, Powell says, I want to look at hard data. Well, the soft data is telling you that the economy is weakening and unemployment is rising and that employment is shrinking. The hard data is telling you just the opposite. And then 2 months later, the hard data is saying, oh, geez, I'm sorry, we got it wrong. Meanwhile, you missed 2 times that you could have cut interest rates 25 basis points each. So you know what? And it's good, Gary, if they don't change it, it's going to get worse, not better.
Yeah, no, I agree with you. I mean, it's been crazy, and it's been crazy for a long time like that. What advice would you give anyone new entering the fixed income market in this new algorithmic technology AI world?
Well, Gary, I'll tell you that I came to the conclusion that is as much as I've done well in this market for the last 30 years, I can convince my son not to come into this market because I don't see a lot of opportunity in this right now. But if you're going to go into this market, I would go into either banking, because banking deals are still going to be happening. I'd go into I would go into private credit, and I'm not so sure I'd go into private equity, but private credit for certain. I think there are a lot more opportunities there in private credit than there is in public credit.
Okay, all right, Andy. Well, I think this has been a really good podcast. If you had to give our listeners 3 key takeaways about navigating the era we're in, fixed income, general markets, what would they be?
Gary, I think you have to be nimble in fixed income markets. You know, you have to look at the information given to you. You have to look at the forward-looking information, and then you have to come to an opinion as to where you're going. And it isn't always where you are, but you have to have a strong opinion as to where you think you're going to go. Basically meaning that hard numbers can be revised, as we've seen, and the employment numbers, you have to look what the Fed's looking at. The Fed's looking at inflation, and the Fed's looking at employment. And one of the things about inflation is, while tariffs are increasing inflation in the near term, it's also slowing down the world's economies. And, you know, having said that, I saw the numbers out of Germany and France today looked actually much better than expected. But I think Europe's been struggling, and I think they're now getting their arms around it. I think you also have to keep your eyes on the Ukrainian war. I mean, I think that's going to come to some kind of resolution. I think no one will be happy about that resolution. But the point is, if you start taking bombs out and you start rebuilding Ukraine, I think that's going to help the world's economies as well. And then of course you have to look at what's going to happen. The European countries have said they're going to spend 5% of their budget for defense. You know, all of a sudden, if the Ukraine war gets settled, do you really think they're going to spend 5% of their economy? In which case, then I think European rates rally because all of a sudden, you know, $1 trillion of bonds won't be issued. So, I mean, you have to keep your eyes. Look, Gary, you have to keep your eyes on the news, whether you're reading the Bloomberg news headlines, whether you're getting your other sources, whether you're reading Bloomberg Daybreak, whether you're reading the Wall Street Journal, whether you're reading Reuters. You have to see what's going on, and you have to have your own opinion. You have to have your own opinion of things. You can't just take other people's opinions. That's what I would say.
Great advice. Great advice from a professional. For those who want to learn more about your perspective or potentially work with National Alliance, what's the best way to get hold of you, Andy?
Gary, I'm very easy to find. I'm on Bloomberg and I'm on LinkedIn. I would suggest that if you have guests listening to this that are not on Bloomberg, then reach out to me in LinkedIn. I will add you. What I do in LinkedIn, the only thing I put in LinkedIn is when I'm quoted in the press or when I do a TV hit. I put it on LinkedIn, so you'll be able to see me from that perspective. If you're on Bloomberg, I'd advise you to reach out to me, and I'll be happy to add you at least to my morning commentary, which is what I've added you to, Gary.
Yep.
I'm not going to add you to everything I put out through the day, but, you know, to the morning commentary. And please, if you're a client, try and give someone at National Alliance some business to pay us back. Don't give it to me. I'll give you a couple of guys you can talk to if you're in the fixed income field.
That's great, Andy. Thank you very much. I really appreciate your insights today on how algorithms are reshaping interest rates and the general trend in fixed income markets. I hope the audience now has a better understanding of the changing world that we live in and the impact of technology in today's markets. I want to thank everybody for listening to algorithms and interest rates, how AI is reshaping fixed income markets. If you have any questions, please contact Andy, as stated above, or myself via my webpage, www.a1solutionsinternational.com, or on LinkedIn. I'm going to finish the recording now, Andy.
Very good, Gary.